Fidelity or BlackRock necessarily to fractionally reserve it or rehypothecate it because it's such an easy mistake for them to get caught out on it. But it's possible. So for me, I think the bigger risk is probably state confiscation. Over time, the financial systems become more and more surveilled, more and more controlled, and they don't really like free-range Bitcoin too much. The reason deflation gets a bad reputation is because deflation is very bad for highly leveraged systems. So we talked about the instability of fractional reserve banking. Deflation is very bad for fractional reserve banking, which is what our banking systems currently are.
Welcome to our channel. Today, we're diving into an insightful discussion by Lyn Alden. Lyn Alden begins by discussing the current state of Bitcoin-denominated loans. She notes that the demand for such loans is relatively low, primarily due to Bitcoin's significant price volatility. Historically, when there was demand, it was often for speculative purposes, such as leveraging to buy grayscale Bitcoin trust shares. Commercial uses for Bitcoin loans remain scarce, largely because of Bitcoin's price fluctuations. The primary concern with Bitcoin is not necessarily about fractional reserve banking or rehypothecation by institutions like Fidelity or BlackRock. These institutions are less likely to engage in such practices due to the ease with which they could be caught and the severe consequences that would follow. Instead, Alden highlights state confiscation as a more substantial risk. If Bitcoin holdings are consolidated into large, easily targeted pools, governments could potentially seize these assets under various pretexts, such as national security or financial stability.
I think that'll less likely be an issue for a while because there's not that much demand for Bitcoin-denominated loans.
Yeah.
And historically, where there have been, it's for leveraging. It's for, you're borrowing Bitcoin, then you're buying grayscale, for example. That's kind of an old trade of the past. There's not a lot of like commercial uses of a Bitcoin loan, while it has this kind of big price variance. So I think it's less about that and more just about, exchange hacks or custody hacks and things like that. For example, I don't really expect Fidelity or BlackRock necessarily to fractionally reserve it or rehypothecate it because it's such an easy mistake for them to get caught out on it. But it's possible. So for me, I think the bigger risk is probably state confiscation. That if everything kind of gets pooled into big, large buckets, they can say, look, these things are no longer withdrawable. And you can make up reason X, Y, Z. You can say it's
6102 in our Bitcoin.
Yeah, or at least saying, it's walled garden Bitcoin, and we can't let it into the wild because of terrorist financing or whatever the reason they can do. That I would consider probably the bigger risk, because I'm less concerned around how Fidelity manages their Bitcoin or BlackRock. I'm more concerned with what they might be told to do with it one day.
Because they want to steal it? Because their own economy's screwed? Their own currency's screwed?
It could be that reason. It could also be, over time, the financial systems become more and more surveilled, more and more controlled, and they don't really like free-range Bitcoin too much. It's harder for them to control free-range Bitcoin. So they could eventually clamp down on that, especially if there's some major negative event and people get very emotionally driven. Imagine if 9/11 was obviously a very tragic event, but then they were able to get the Patriot Act through fairly easily, and they were able to drum up people's desire to go to war with a country that wasn't even involved in the attacks, Iraq. Imagine if there's some sort of similar major event and they say, look, we have to clamp down on Bitcoin. We can't let terrorist financing happen with it, or we can't let X, Y, Z, or, we have to have more control over this. And you can get kind of an excuse to block the exits. Even just financial repression. Like, for example, when Argentina is having a currency crisis, and they pass things saying banks can't, offer it to their customers, or even fintech companies can't offer it. And they never say it's because we're having a currency crisis. They say, look, it's, money laundering and AML, and we have to maintain bank stability. They'll say any number of kind of normal sounding jargon for why they can't do it, when really it's because they want to slow down their currency crisis. You see that with Nigeria, you see that with Turkey. And the way they're often phrased it is, either something like that, like we want to do safety and stability, or they'll blame, quote, speculators. The people are speculating with the currency. And so they'll try to block the exits there and kind of demonize a certain group. So I do have concerns around, in many jurisdictions, eventually a sovereign entity kind of taking over those big Bitcoin honeypots. I think there are interesting price signals from that. But I think also part of the issue is people underestimate the risk that they take on. And so with DeFi, it's less risky for the borrower, but it's very risky for the lender, because in addition to liquidation risk, you have hack risk.
Yeah.
And that's something that often gets kind of overlooked, I think. So it's not necessarily priced accurately. But I would expect probably over time for the Bitcoin collateralized lending rates to go down, because if you look at mostly how they work, like the ones that do it properly, like Unchained, for example, there's no rehypothecation. Yeah. Those have very low loss rates. I mean, 0 in many cases, because you're fully collateralized by the Bitcoin. It's a liquid market. Technically, the only way that you could really, as a lender, lose money is if Bitcoin has a very liquid loss in price. So it basically it would lose value so quickly that you can't even sell the collateral and recoup the loan. So outside of that very specific scenario, it's a mostly risk-free lending. You'd expect the rates to probably go down eventually, but it's not a market that I follow super closely. And I think that then it just comes down to making sure that the terms are known to people. So one of the criticisms that people have against fractional reserve banking is that the depositor often doesn't really understand how that works. That it can be categorized as fraud because, like if I go to my bank and I sign up a bank account, and I'm signing whatever long things they're doing, it might say somewhere that they could have liquidity issues or something. But most people, when you ask them, a lot of them think the bank actually has their money. Yeah. And so it's like, would it be the same if everyone was kind of educated on what exactly they're signing up for when they sign up for fractional reserve banking? But yeah, in
they
general,
don't really want you to be educated.
Yeah, I think they don't really want you to. So I think you can argue that a free market, especially when it's an educated free market and people know what they're choosing, I think obviously that's better than a centrally controlled price for money. I mean, if the more successful Bitcoin is, the more that makes that likely. I don't think it's going to happen in 5 or 10 or 15 years. But I think over the long arc of time, it's certainly possible. And that's why I'm less interested in kind of movements like end the Fed. And it's more like I'm interested in building an alternative and seeing that outcompete the Fed.
Alden concludes by discussing the pressures on modern financial systems to favor inflation over deflation. Due to the high levels of debt in the system, deflationary pressures are typically countered by policies that increase the money supply, making debts more manageable. This approach, however, can lead to long-term inflationary trends, as seen with the consistent growth in the money supply over the years. Alden's analysis has profound implications for both Bitcoin and traditional financial systems. For Bitcoin, the potential for state intervention and the need for transparent, secure financial practices are critical considerations for investors and institutions alike. For traditional financial systems, the discussion highlights the inherent instability of fractional reserve banking and the challenges posed by deflation in a debt-laden economy.
The reason deflation gets a bad reputation is because deflation is very bad for highly leveraged systems. So we talked about the instability of fractional reserve banking. Deflation is very bad for fractional reserve banking, which is what our banking systems currently are.
So it's bad for who? Which people in that? The people who have the debt? Because I'd say that's...
Well, anybody who has a bank account.
Yeah.
Which is most people. It's one of those things where when you encourage the debt to build up to those extreme degrees, and then you say, well, now we want deflation, you're going to have a really bad time and people are going to find it intolerable, and then they're going to want out of it. So that's where it gets its kind of bad reputation. But in a more equity-based economy, so one that's less debt-based and is more equity-based, then deflation's a good thing. It's good for prices to go down over time. I mean, the fact that, for example...
That's what Jeff talks about.
Yeah, his exact point. So if you look at, say, the late 1800s in the U.S., there was long stretches of deflation, and yet that was a kind of a major age for new technological growth. The U.S. became the world's largest economy at the time when it often had persistent deflation. The Renaissance was basically built on a hard money situation. You had this, the gold floor and that went undebased for a very long period of time. Those things can be very good. It's just that they get a bad reputation because the way we've structured things for the past century and a half or so just don't mix at all with deflation. So we think deflation's bad, even though at the foundational level, it's not.
But deflation is worse for the people with the most debt
Yes.
because it's harder to pay it off.
Yeah, basically, you owe debts in a unit of money, and the amount of money supply is shrinking.
Yeah.
At any given time, if you let it build up, there's a crazy ratio. Like in the global financial crisis, in the U.S., there was something like $50 of debt for every dollar of base money.
Okay.
Which means that most of that debt is structurally unpayable. And so you get a situation where if you let it deflate, it just starts feeding on itself. You never should have gotten it that blown up to begin with. And so that's why you almost never see a banking system implode on itself for too long, because eventually, no matter what someone's kind of view is, they say we have to stop this and reverse it. So all the incentives always kind of point toward more inflation, more supply growth, make the debts more payable. And so that side wins like 99 times out of 100. Deflation in that sense is prices going down because technology is getting better.
Yes.
I mean, that's good. That's a good thing. We see it. I mean, our best performing sector is technology. And that's one of the few areas where deflation's happening because it's strong enough to override the money supply growth. So for example, it used to, the cost of a megabyte of storage used to be prohibitive. And now that's trivial. We buy terabyte drives, for example. And so technology, that field is able to kind of make some things cheaper so quickly that it even overrides the fact that money supply is going up on average 7% per year. Most sectors can't overcome that. But it's funny that people think of deflation as a bad thing, whereas it literally happens in our best performing sector on a regular basis. Every contract that exists, so everyone's wage, every business supply contract, that's denominated in the currency of a country. And so a central bank that can come in and increase the amount of currency supply or decrease the amount of currency supply, they're basically deciding who on which side a contract is winning.
Lyn Alden's insights offer a comprehensive understanding of the complexities surrounding Bitcoin and broader financial systems. From the risks of state intervention to the implications of deflation and the evolution of decentralized finance, her analysis provides valuable perspectives for anyone interested in the future of finance. As we navigate these evolving landscapes, informed decisions and continuous learning will be our best allies. Thanks for watching, and don't forget to like, share, and subscribe. Please like and subscribe my channel.